Okay, all right. Let's go ahead and get started. Folks are still coming in, but they'll join us as they come along. First, I want to say thank you for attending this webinar series at Cash Flow Champs here today. It's our intention to bring you good content on a weekly basis and just to develop good relationship with you and to be a resource for you in the multifamily syndication space. Today, we'll be covering the topic securing financing for multifamily syndication. And as we go through, we're going to touch on certain things. We're going to talk about what type of financing are available in multifamily syndication, agents of financing. We'll talk about basically Fannie Mae and Freddie Mac when it comes to multifamily space, and recourse versus non-recourse lending. And we'll also touch on debt and equity, debt brokers and equity just for a little bit. So we'll cover those things. I'll just take a minute just to introduce myself and for those who don't know me, and just to provide some resource for you that may be helpful. I'm Paul Sr., one of the managing partners at Cash Flow Champs, and I live in Maryland with my family. And to get some more information on us, you can always go to our website. You can go to cashflowchamps.com / you can go to cashflowchamps.com, and if you hover over about us, then you can go to our team and you can see information in each of the 6 partners that makes up Cash Flow Champs. I'm also co-host of the Cash Flow Champs Real Estate podcast with my partner, Prashant Kumar, and we post that every Friday. So we have an episode that come out pretty much every week. Great content there as well. Right now, our team portfolio is about 146 million asset under management, a little over 1,600 doors, and we're looking to grow that. Right now, we have a deal, at least 2 deals on the contract. I got another one this week, but certainly looking to close one later on this month or early next month. And that's a beautiful asset in the Atlanta MSA. So that's a 506C, so we can speak about that. And if you want to learn more about that opportunity, we can share that with you as well. But some resource that we have for you includes our underwriting session. So every Saturday at 4 p.m., one of our managing partner, Charles Seaman, he underwrites deals. He goes through the rent roll, the T12, and the OM and show you how we underwrite deals and also entertain questions and help folks to underwrite. That's one of our gifts back to the real estate community. I believe that Charles is one of the superior knowledge mind in terms of underwriting deals. So you can check that out. You can just scan the QR code on your screen there. And we also have the Cash Flow Champs Aristocrat Coaching Program. It's a coaching program. We have some students in it right now, and it is growing. And we're just helping folks who are trying to learn to syndicate deals as well. And also those who have a portfolio and try to grow that portfolio, we're here to assist in that manner. So, if you're interested in that, also scan that QR code. And we had a virtual summit last November. We're going to have one again this year. It was a great success. So well over 1,300 attendees. People signed up last year. It was a great success with some of the great speakers, great operators across the country, and we're looking to do that again in November 8, 17, 18 to 19. So join us there as well. If you want to get the recording from last year, just go to cfcsummit.com and you pay a small premium for that. Now, as I go through, if you have any questions, feel free to just put them in the chat or the Q&A, and we will get to them. If not during the session, then we'll get to it at the end of the presentation. Just from a disclaimer standpoint, attorney wants us to do this. I want to let you know that I am not an attorney, a financial advisor, or tax advisor, or an accountant. The purpose of this webinar really is for information purposes. We like to get information out to you as much as we can. That's why we do these webinars and the podcasts and different things we do. So if you need professional advice, you want to see professional advice from the appropriate personnel, this is for information purposes. So let us jump into the topic for today and engage the topic for today, and which is securing financing for multifamily syndications, right? So what are the different types of financing that's available for the multifamily syndication? We'll just touch on that first and foremost, starting off, right? So, well, number one, for multifamily financing, you can go to your local bank, right? You can start there, right? Local banks in your area, you can check those banks out. Some of them do provide financing for that. So you can go to your local credit union, you can go to your local community banks and you can talk to anyone there regarding financing for your project, right? So normally those type of loans that you get there would be a recourse debt, right? So a recourse debt really holds the borrower personally liable, right? So we'll touch more on recourse versus non-recourse later, but recourse will hold the borrower personally liable. So in general, recourse debt allows the lender to collect what is owed for the debt even after they have taken back the collateral, right, which is a property. So for example, if you purchase an apartment complex using a recourse debt from a local bank and you run into financial difficulties, you know, with the mortgage, the bank could foreclose on the property. They can, you know, get what they can from a foreclosure sale proceed, and they can still hold you liable for any deficiencies in the outstanding balance, right? That's a little bit different from agency, right? So with agency financing refers to government-sponsored enterprises, such as Fannie Mae, Freddie Mac, FHA, Federal Housing Authority. So those all fall under agency financing, right? So the two most active agencies in multifamily are Fannie Mae and Freddie Mac. So it is important that you know that these agencies, they do not lend money directly to the borrowers, right? The way it works is that the agencies such as Fannie Mae and Freddie Mac, they have a network of approved lenders. And these approved lenders make mortgage loans, and then Fannie Mae and Freddie Mac buy and securitize these mortgages originated by these approved lenders. So agency loans are conventional fixed rate loans. They're always in the first mortgage or lien position. So typically agency loans use stabilized income producing assets like multifamily real estate as their collateral, right? So both Fannie Mae and Freddie Mac, they both have underwriting criteria for both the borrower and the property that they have to meet in order to get qualified for these loans. So agency debt are non-recourse debt, right? So they're there and they're available for folks who qualify for them. Now, there are other type of options that provide financing in multifamily syndication as well, right? You have CMBS, you have HUD, you have a life insurance company, you have bridge lenders for sure, right? Bridge lenders are very popular, still popular to an extent, but things are changing there. We'll touch on that a little bit too. So the CMBS, which is commercial mortgage-backed securities, CMBS loans, they too hold first position mortgage on commercial properties, right? So CMBS loans are typically offered by commercial banks and investment banks. So banks do not hold CMBS loans typically on their balance sheet. So they tend to have low interest rate and higher leverages. So you can get CMBS loans 75 to maybe 80% LTV on those type of loans. So typically you have terms of about say 5 to 10 years with amortization of 25 to 30 years on your CMBS loans. Plus the CMBS loans are usually non-recourse and assumable, right? For financing your multifamily property, you can also use bridge loans as well, right? Now, bridge loans are typically short-term financing, right? So the bridge loan are used to quote unquote bridge the gap between your current need for capital and more long-term finance solution, right? So bridge loans tend to be more flexible. In general, lenders offer customized loan structure just based on the borrower's needs, right? So some bridge loans have short terms of say 12, 18, or even 24 months, right? So you want to be careful as a borrower with such short-term loans, because in cases where you do not execute on your business plan to precision, you can start a real slippery downward spiral. So you want to be careful of that. You also have bridge loans that can be more appealing in terms of loan terms, like you can have a 3-1-1, right? Where you get 3 years of IO and you get an additional 2 12-month extension, you know, on that loan in case you need it, right? So typically the borrower will pay a premium for those extensions, right? So bridge loans too have high leverage, right? So you can have up to 75 to 85% LTV or LTC. LTC is loan to cost, right? Of course, LTV is loan to value. But bridge loans are not as popular today as they were, say, 2 or 3 years ago, when folks were pretty much using them almost as agency debt, right? So, a matter of fact, many operators are facing challenging times right now today because of the bridge loan that they use, right? So the market has changed today compared to what it was in 2018, 2019, 2020. And so now we're looking at rising interest rate, we're looking at decompression cap rate, and that leads to lower or decreased valuation, right? So if you have an expiring loan term and you're unable to refinance because the valuation is not there, it can be a scary situation, right? And it can, something like that can lead to capital calls, and worse, it can lead to, foreclosure of the property itself, right? So there are folks who are facing a lot of capital calls right now, and folks who are, unfortunately facing foreclosures right now just because of the bridge loan. And a bridge loan in itself is not bad, but it has to be used for what it was meant to be, which is a bridge. It is not a long-term debt, right? So you want to use the different products that are out there the right way. So bridge loans are normally floating rate debt, so you have to always be cognizant of your multifamily financing choice, right? So you got to know what type of loan you're getting into for your multifamily deal. Now, let's touch a little bit on recourse versus non-recourse lending, so to speak. Now, one of the biggest difference between agency lending and bank lending is the liability to the borrowers. The liability can come in the form of a recourse or non-recourse debt, right? So in case of a default on a loan by the borrower, recourse lenders have the ability to gain access to the borrower's personal asset to satisfy the debt owed by the borrower, right? So, so personal assets could include the borrower's checking account, it could include borrower's saving account, could be their personal residence, it could be their business assets and so forth. On the other hand, non-recourse loan only allow the borrowers to seize and sell the collateral that's supporting the debt. So in our case, when we buy multifamily, then if we default on that, then the lender would tend to more go after just getting the asset back, which is a collateral that support the loan. So all else being equal, non-recourse loans are considered to be preferable for borrowers in all cases, right? So the vast majority of Fannie Mae and Freddie Mac loans are non-recourse. On the other hand, the vast majority of bank lending is funded through recourse transaction. Now, let's see if I have any questions here. All right, let's continue. Probably pop in later. Now, a small segment of banks have the ability for non-recourse loans in the small balance families, in the small balance multifamily space, right? However, they will probably decrease the leverage of the loan and maybe also decrease the loan proceed, right? So they just want to make sure that they're protecting their downside. So some recourse loan have what's called a bad boy carve out. So in case there is fraud or negligence or something like that from the borrower, then they can come after you, right? So bad boy carve-outs are basically loan documents that protect the lender and also hold the buyer responsible for running the property in a dishonest way, right? So you have to know that even though you have a recourse loan, if you do something fraudulent or negligent, it can actually turn into a recourse loan. So you got to choose the right loan option, right? So how do you choose the right loan option for your deal? Well, of course, it depends on the business plan for your asset, right? For example, if you're purchasing a 100-unit heavy value add multifamily property that needs, say, $25,000, $30,000 per unit in renovation, and you only have that property, say 30-40% with physical vacancy level, you may want to consider a bridge loan, right? Something like that, for one, agency would not touch that, right? Because it does not meet their 90 for 90, which is the property has to be stabilized for at least 90 days with a minimum of 90% occupancy, right? So that would not be an option in terms of agency. So you can normally get higher leverage on bridge loans, right? So bridge loans can allow you to include the capital expenditure into the loan amount. So this is good since it can also reduce the amount of money that you have to raise to make the deal happen. In another example, if you have more like a Class A property that has been stabilized and fully rented, then that's something you want to consider, long-term agency debt on, right? So something that you can just get up and running and just let it run for, a good 8, 9, 10 years. Normally people exit property long before that time period in terms of normally between a 4 and a 6 year hold period is what people are projecting right now. So of course it depends on your scenario, depend on your situation. You choose what type of product you want to go with when you're securing financing for your multifamily deal. I'm going to touch a little bit. On loan guarantor and maybe key principal, and just kind of open it up for some questions. Anybody have questions can go ahead and start putting those in the chat. We normally keep these sessions to about 30 minutes or so. And loan guarantor. Now, as you try to secure your financing for your multifamily deal, especially if you're just starting out, you're probably going to need a loan guarantor or key principal, right? And there are certain liquidity and net worth requirements that you have to have when you're trying to get an agency loan, right? So you may want to start networking with loan guarantors. You may want to start networking with key principals in order for you to close your first deal, if this is going to be your first deal, right? So what happens is that you have to probably give up a portion of the deal to the loan guarantor in order for you to kind of take down the debt. So lenders are typically looking for 3 things to satisfy these type of loans. Does the sponsor have the net worth of the loan balance? Do they have the liquidity? And do they have the experience, right? So typically they're looking for the net worth to be, like I said, the loan balance and 10% liquidity. And they want to have somebody who have the experience, who've already kind of probably signed off on one of these loans before. So for example, if you have a $20 million deal that has, say, a $16 million loan balance, you will need a sponsorship team that have at least $16 million of net worth. Now, it doesn't have to be one individual, it's the whole sponsorship team, combining their resources together to kind of meet that requirement, right? And also you want to have at least that $1.6 million in this case for liquidity, which is 10% of the loan amount, right? So just keep that in mind when you start thinking about the size deal that you want to take down. You also got to take into consideration, who is on your team. So lender will always want to know that your team has the experience for taking down these type of deals, right? So remember, the lender, they have a vested interest here. Actually, the lender is the biggest investor in your deal, right? So they will want to ensure that things are done properly, and they'll check into things just to make sure that everything is in place before they actually disperse those type of funds. So loan guarantor is actually taking on the risk in guaranteeing that loan in many ways. So they need to be compensated. For one, their reputation is on the line, right? So it'd be wise that the loan guarantor is kind of stay in touch with the operators even after the deal has closed, just to ensure that things can continue to run smoothly, right? So a loan guarantor, key principal, those are important pieces as you're trying to secure financing for your multifamily syndication, especially if you're dealing with the size property that we're dealing with, which is typically 100 units and better, right? And you can also engage debt brokers as well, right? When it comes to the multifamily financing world. The last thing we will mention is about these debt brokers. The debt broker can help you to secure financing for the multifamily real estate as well, right? They can help you to shop the deal that you have. So what they can do, they can get your deal and they can shop it out to many different lenders. and they can just have these lenders kind of compete for your business, right? So of course, by doing so, then you as the buyer of the real estate, you can end up with the most lucrative term. You can end up with different things to choose from in terms of what different lenders has to offer, because you have a debt broker working on your behalf. Now you can shop it yourself if you want to do that, right? But it is better, especially at 100-unit level and above, just to have the debt broker do it on your behalf. Of course, there's a fee that you have to pay, maybe a half a point or a point to the debt broker, depending on the size deal. But then the fee can be negotiated too, right? You starting out smaller, they may charge you a point, whatever. But as you start getting bigger deals, 20, 30, $50 million deals, then they often have no problem in terms of trying to reduce their fee, because they're dealing with bigger numbers at that point in time. So you can consider that broker, or you can walk it around, try to shop it yourself. But you have to put a lot of legwork in there, and you can be successful at doing that too, but it would just take more legwork. I think probably a better use of the time, at least for us, is to let the debt broker go and work on our behalf, and then we use our time and energy to find the next deal and to just keep the pipeline full. But of course, the choice is yours, right? So let me kind of pause there. It's 11:23. Just kind of see if there's any questions, anything like that. But certainly, we'd love to entertain any questions that you may have. Let me take a look here. So Julian Peterson. Oh, Julia, thanks for being here. I'm a big fan of you. Congratulations on your daughter graduating from, I forget the name of the school, but second time in 2 years you haven't had keep your Tuesday at 8 or something like that. Zoom at 8, right? So anyway, Julie is here. Nice to have you, Julie. Julie said Julie is a big lender, of course. Julie said there is no additional fee on agency loans with brokers. Okay, so she's saying that she's making that point there. Any tips on Tyler White is asking, any tips on connecting with loan guarantors and lenders, right? Well, Julie's here. I think she's a lender. Julie Peterson, research her. That would be my recommendation if you want to get financing on something right now. And loan guarantors, you just have to check around in your marketplace, right? See who is doing deals in your marketplace. Typically, loan guarantors, they like to start out in places that they're very familiar with. So if whatever your market is, you want to find out who is doing deals there. And for people who have gone full cycle in deals and things like that, you want to make those relationships, build those relationships, just like you would anything else. Just reach out to them in particular, and if you know somebody who knows them, then you probably can get a referral that way. Okay, so Julie's daughter graduated from ASU. Woohoo! It's good job. And she's Old Capital Lending, she says here. Okay. Well, all right. I mean, I don't see any other questions in here. Want to appreciate you for coming here today. We appreciate you supporting these webinars. Cash Flow Champs, we do have a deal that's live right now, 506C. We are about 81% subscribed right now. And we're trying to close this deal. I think later on this month. Later on this month. So I mean, if you want to be a part of it, it's a great deal. The numbers on it are phenomenal. 20% average annual return. I think we got a 17% internal rate of return, and cash flowing day one with an 8.1% cash in cash. So it is a phenomenal deal. We have been underwriting deal for a long time. And this one came across, and we just could not pass up on this one. It was just such a good of a deal. It's in the Atlanta MSA, 236 units. The prior owner has already renovated 231 of the units. So I was personally there for the due diligence, and I'm telling you, those look good. The properties have high occupancy right now too. I think it's like 94% occupancy we have. So it is just a great play for us to just get in there, raise rent, run the property right, and get some returns to our investors. So if you want to talk about that some more, just let me know. Let Prashant Kumar know. You can always email us or reach us. But we thank you for your support there. So let me see if any other questions. If there are no other questions, we're just going to call it for today. And looking forward to seeing you guys again next week. Oh, Jeannie Bolin. Hey, Jeannie, how are you? So she got to run. She said Julie's great. All right. So thanks again. We appreciate you coming. See you next week. You'll get a copy of this session here today. And again, thank you for your continued support. Reach us cashflowchamps.com. Check us out there. And if we can be of any help to you at all in the industry, we're here to help you guys. Just let us know. Okay. Have a great day.